Hello everyone. So just bear in mind, this video is for the WHI models only. However, with that being said, you could probably take some of this for any other strategies that you may have. But moving on here, I'm just going to quickly go through a scenario that happened today. So we had the previous day low swept, okay? And then we had a retracement towards this premium array. We then had a strong break of structure here, and then we had an order block left behind, which appears very clean for an EM3 model. Okay, however, the trade idea became invalidated because it's now risky, simply because once we had that break of structure, the market retraced a bit and we actually swept this previous session low, right? And I don't know about you guys, but I'm not trying to sell if we just took out some sell side liquidity, right? Especially if this lines up pretty well for the EM2 models that we have here. So EM2 model that we have essentially says that once we sweep an old previous session low liquidity, we can then look for a 10-minute mark structure shift, right? So we can kind of see here, in real time, like this, the market's really playing out right now. How, and the reason why I have this as invalidated, right? So say if we still took this entry, right? A sell at this order block, right? After we swept this, we can see that the market had a slow return to this order block here. Now, initially, we did have a strong reaction, right? Strong reaction off that order block. Then it tested it again, decent reaction, right? The market then went into it again, but closed strong as a bullish candle, not looking that good. Okay, and if we take a look at the rest of the candle, it's like, yes, it's looking fairly weak, right? Like the odds of this order block failing is incredibly high. So just to quickly go over the in trade invalidation rules, there's three ways that a trade can be invalidated before entry, right? Because we have break-even rules and then trade idea invalidation, and they're essentially kind of the same concept. So the first way that a trade can be invalidated is if another 10-minute break of structure occurs after the 10-minute mark structure shift that we originally looked for an entry occurs. So just to try my best to show you here, this is like our mark structure shift, right? And say if the market on the 10-minute time frame broke this low before having an entry, the entire setup would be invalidated, right? And the reason why I have it set up that way is because I noticed it would help with a lot of reversals, and we could save like a lot of losses. So definitely something to keep in mind. I'll even show a quick example here from the Telegram group, just because I feel like it's just so important that you really have to take a look at how this works. So I think I have it somewhere around here. Okay, perfect. So we can kind of see here that we had a 10-minute mark structure shift. Okay, market created a low. Now the theory is we should have our entry and mitigation into this order block right before we even break this low, right? This should be a short-term low. So if we don't have mitigation into this order block and the market instead kind of ranges and has a break of structure, we can kind of see this as a very high probable potential kind of reversal liquidity sweep. And then we can see here the order block had little to no effect whatsoever. So this is indeed just a reversal, and it's actually aiming to take out this previous day high rather than this previous session low. So very important step there that invalidated this entry this morning. And then if we take a look at another way a trade can be invalidated is if opposing liquidity target is met. So that's exactly what happened today. We had the break of structure. However, we had some opposing liquidity swept before the entry, so that invalidated this whole setup, right? Because what we look for in EM2 model, we're actually looking for, in this case, previous session low to be swept. In this case, well, it's old previous session low before we look for a buy. And then if we look at ICT concepts, what is that? it's pretty much just like a turtle soup setup, right? We're taking out sell side liquidity, right? And then we're starting to look for a buy model, right? So that invalidated this setup this morning. And then the more obvious one, if the original drawn liquidity target is met before entry, I'm no longer looking for a trade, right? Because the drawn liquidity has been met. There's nothing for me to target. Now, in terms of break-even rules, pretty much the same thing, except like we're already in the entry. So I might have an example here somewhere. Let me see if I can find one for you. So if I go here, break even, I might be able to find. I don't have break evens too often, so this might be kind of difficult to find. But let's see. Closed R equals break even. Oh, you know what? I think some back testing I did, we can find one. Okay, so yeah, this is a good example actually. So we can see that the trade has been entered already. Here, I'll extend this for you. So the trade has been entered already. We then break structure again on the 10-minute time frame. So there should be no reason for the market to be returning into this order block unless it's reversing. At least that's the logic. Don't get me wrong. Sometimes, that logic is wrong. However, in the long-term scenario of things, it's really saved some losses. So I think it's definitely worth our time to do. If we look at another way that a trade can be set for break even is if kind of similar. If opposing liquidity target is swept, then we have to set break even, which I think I have an example of that in June of 2022. If I just look around, I think this one. No, this is a different kind of example. This is a great. Okay, perfect. So here we had our entry fairly early. We had a super strong reaction off of the order block, so it's looking good. But we can see that we have some session liquidity that was swept, right? So the market at this point is so close to that previous day high, right? And we swept this buy side liquidity. We should be setting our break even because it should have no reason to be returning all the way down here back to our order block. It should just be continuing its path unless this is just one huge Judas swing, which look at the time that this occurred in between 9 to 10 a.m., which is approximately when we can expect a Judas swing if it occurs. So that invalidated the trade in that sense. And then, of course, the more obvious one, if the drawn liquidity target is met, then that also invalidates. Well, it doesn't invalidate, sorry. It causes the trade to be set break even. The reason why I say that is because sometimes you can, well, actually, in this trade, you can see that the take profit is slightly past the draw on liquidity target, which is completely fine for this models. I have it set up kind of perfectly that it's not really about the liquidity targets. It's more about like maximizing how much the market potential can move. So we can see that, say, if this previous day high was swept, we should also be setting break even, especially if it's previous day high, because that's strong liquidity. But that's going to be it for the video. So